Can I request you all? I request all of you to kindly mute yourself. Just give us a minute. Suraj, if you can mute yourself, that'll be helpful. Okay. So good afternoon, everyone. Welcome to the next webinar of Hi Mumbai. Sorry. So Aska?
Yeah.
Thank you. Okay. So good afternoon, everybody. Welcome to the next webinar of Hi Mumbai. This is an exciting one. I have with me Rajshri Sabnavis and her colleague Isha. We are going to be today talking on something very important, and also it's timed in such a way because a lot of your input tax credits is going to be coming up. So we have called in two experts. Rajshri has been a veteran, what do I say, CA. She's already worked about 3 decades. She represents a lot of direct tax committee in Mumbai Chamber of Commerce. She's here to kind of help you all. Isha is going to be doing a rudimentary presentation today. So what we would do today is we would basically first finish the presentation. Please do keep typing your questions in the chat. And then once the presentation bit is over, we will kind of individually take up those things and start addressing them. So without further ado, I would like to invite Rajshri to give us a little introduction of herself and Isha, and then start the whole session. Over to you, Rajshri.
Thank you. Thank you, Nabil. Good evening, everyone. It's really nice to, in fact, be a part of TIE Mumbai, and it's also a pleasure for us to, in fact, interact with the lovely audience that we have here today, because nothing can be more exciting than being talking to or surrounded by people who have the energy. And I genuinely believe that startups do bring in a lot of energy to the table. And clearly, because we too, as a firm, I mean, Naveen is kind enough, he did mention a little bit background about myself, but I don't want to take too much of time just focusing on myself. I.e., yes, I'm a chartered accountant, company secretary. I'm also a trained mediator under the Ministry of Corporate Affairs. But having said that, my journey has been that I've been an entrepreneur for more than now 12 years. 14 years. And essentially, so we've been through the grind and we still face challenges every day. The challenges could be on various counts. And but at the same time, you do get the kick in terms of when you succeed. So there will always be ups and downs, and that's something which is part of life, part of every business cycle. What's more exciting is the fact that, the value that you bring to the table and having faith in yourself that what you are doing, you're enjoying it quite a bit. And whatever challenges that do come your way, there will be solutions, and may not necessarily, all of it can be solved by ourselves. You can always consult. You do have mentors, and TIE is a fantastic platform, the way I've seen it, the way they've been operating. Even mentorship is something which is available. So having said that, on that note, and of course, I have my colleague Isha, who eats, breathes, to put it very simply, eat, breathe, talk, indirect taxes, okay, and GST, to be more precise. So in a way, clearly, you do have the benefit, and we all have the benefit of Isha sharing her perspective on what the law is all about today, the practical nuances and difficulties that one does face. So we will be pushing the Q&A session right at the end, but as Naveen already indicated, feel free to post your questions in the chat, and clearly we will be addressing all the questions till time permits. And on that note, just to give you a quick background in terms of what, sorry, just one sec. Okay, so what the clearly what the law is all about. Very quickly now, of course, given the fact that the audience out here, most of you all are all startups, you all would pretty much, I don't want to take you too much into history, but I think a little bit of understanding of where this legislation kind of found its roots is important. So in India, we do have, of course, one is the federal income tax, which is your tax on the income that you earn. The second is what we refer to as the business tax or the transaction tax. And when I talk about business tax, transaction tax, there are three limbs to it. One is when I look at importing goods into the country, which is customs duty. The second was essentially on manufacturing, which was excise. Third was essentially sales tax, i.e. when there is an actual sale, and of course, stock transfers, etc. That is all subsumed within the sales tax regime, but sales tax. And then there was an introduction of service tax, which was a tax on services. Sales tax eventually got, replaced by what we would say as VAT. Now, why was VAT introduced? Essentially, to ensure that there was no double taxation on the same transaction. Second, whatever was a value addition, you only paid tax on that value addition. But at the end of the day, and plus each state had its own regime in terms of entry taxes, because if the goods had to travel from one state to another, each state, to put it very simplistic, was more like a profit center. Of course, you would get credit for the central sales tax that was paid, but at the same time, state also had their own taxes. 2017 is when, of course, GST was a law which was in the offing for quite some time. But it's just that GST as a law was introduced in 2017. So July 1, 2017, when the law came into effect, there was a constitutional amendment also that was carried out, because you had to introduce that in the parliament as well. And the law was effective July 1. So what is GST? GST, the key objective was to replace VAT, service taxes, and excise across, and have one single tax. Question was, this one single tax ensuring transparency, ensuring that the tax net was wide enough to cover various businesses within the tax purview. So this was GST. When GST was introduced, there were a lot of hiccups in terms of people had to change their systems, make changes to the way they were doing business. Invoicing was compulsory. GST new registrations had to be taken. There was also a question of, okay, what happens to my past credit? Okay, so we will be addressing now, our specific focus for this particular session is going to be around, we will be focusing on input tax credit. What is input tax credit? That is, I will now hand it over to my colleague Isha, who will actually walk you through some of the definitions under, what do you mean by input tax credit? What is eligible? What is ineligible? And of course, then we will also touch upon some of the compliances. Why is input tax credit and why did we pick that topic? As I said, see, we also being a startup, at the end of the day, every business, and when I refer to cash, it's obviously the banking channel that we talk about. Input tax credit is cash, because if I've procured something and if I'm going to be using that for rendering services, clearly there is a cost that I have paid. And question is, since GST as a law applies only on the value addition, it was but necessary to get a sense of the credit for these input taxes. So without much ado, I will be handing this over now to my colleague Isha, who will be walking you through some of the definitions, input tax credit, challenges, nuances, and of course the compliances. And then we will, as I said, we will be taking the questions right at the end. Over to you, Isha.
দেখে না তুমি ও ইনপুট ট্যাক্স তোমারও দরকার হবে
We will have to share the PPT, right? Shabnam, will you be sharing the PPT on the screen?
Yeah.
Shabnam, will you be helping share the screen, PPT? Guys, just give me a second. Let me just figure out. Start at least, no? Start, right. Yeah.
Okay, good evening all. I'm so sorry there were some technical glitches from our end. Yeah, so the two burning topics for GST, under GST for startups or for large organizations is input tax credit and GST compliances. Input tax credit, mainly the reconciliation bit, and GST compliances with respect to the various GST returns which are required to be filed. We first start with input tax credit. So we go to the next slide.
Sure, I will go the screen. Yeah.
You are sharing the PPT. You are sharing the PPT or Shabnam?
Share it. You share it.
Okay, so under input tax credit, we shall be covering the definition of input tax credit, the eligibility, the primary, the secondary condition, reconciliation of input tax credit with GSTR 2A, 2B, block credit, so as to say the input tax credit which is not eligible to be availed. The recent ruling on common employee cost incurred in head office, there were two rulings, one for one of the Maharashtra AAR and the other by the Karnataka AAR. The basic concept of transitional credit and the recent Supreme Court ruling on transitional credit, which has opened the window to again file forms for transitional credit. Moving on to the first slide on definition of input tax credit. So what is an input tax credit? What do we mean by input tax credit? We can move to the next slide. Okay, so input tax credit means credit of input tax. Now, what do I mean by input tax? Input tax means any tax which is central tax, state tax, integrated tax, or union territory tax, which is charged on procurement of any goods or services made to a registered person. Central tax, as you all may be aware, is CGST, state tax is SGST, integrated tax is IGST. CGST, SGST is charged on intrastate supplies and IGST is charged on interstate supplies. So any such tax which you have discharged to your suppliers on procurement of any goods or services, that means input tax. And when you take credit of this input tax, it is referred to as input tax credit. Now, to understand what is input tax, it is also important to understand what is goods and what is services. So, moving on to what is goods. Goods means every kind of movable property other than two things, which is money and securities, but it includes actionable claims, growing crops, grass, and things attached to or forming part of the land, which are agreed to be severed before supply or under a contract of supply. So in short, goods means every kind of movable property, but it excludes two things, which is money and security. Now, what do I mean by services? Services, the definition of services under the CGST Act is very broad to mean everything other than goods, money, and securities, but it will include activities relating to use of money when a separate consideration is charged. We'll discuss this in detail in the next slide. So we can move on to the next slide. We can move to the next slide. Have you shared the PPT about? Is your mailbox open? Okay. So as I said that goods means every kind of movable property. Now what does movability mean? Movability as such is not defined under the GST Act. It is defined under the General Clauses Act 1897, and movability means property of every description except immovable property. So to just give you a very small example, if there are crops, grass, wood, etc., which are attached to the land, the same will not be considered as movable property since it is attached to the land. So it will be considered as immovable property and not qualify as goods under GST. But the moment there is a contract entered into to sever the crops, grass, wood for supply, they will qualify as goods. Now, what do I mean by actionable claims? Actionable claims as such, the definition again is not mentioned anywhere in the GST Act. Actionable claims as such is also very wide, but for the purpose of GST, only three things are considered as actionable claims, which is lottery, betting, and gambling. So when it comes to actionable claims, only lottery, betting, and gambling shall be treated as supplies under GST, and all other actionable claims shall be outside the purview of GST. We can move to the next slide. When it comes to services, as we have discussed earlier, money and securities are not part of the definition of service. However, if there is any transaction which is for use of money and for which a separate consideration is charged, that shall be considered as services. To give you a very small example, a demand draft issued by a bank on deposit of cash. So if a demand draft is issued, then that demand draft issuance is not considered as supply of service. However, if there is any commission charge for issuing the said demand draft, then it shall be considered as conversion charge and it shall be considered as service and liable to GST. So money as such is not covered under the definition of service, but any transaction in money for a consideration that will be considered as service. Moving on to the next slide. So we have already covered what is input tax credit. Now moving on to the eligibility of input tax credit. So there are certain conditions prescribed under the Act to be able to claim input tax credit. One of the most primary and important conditions is that any goods or services which are procured from a supplier have to be used in the course of furtherance of business. So the moment you are procuring anything which is for the use of furtherance of business, input tax credit in relation to those goods and services can be utilized. Now, what are the primary conditions? Primary conditions are that the recipient, who is a registered person under GST, should be in possession of the tax invoice or debit note or any tax paying document which is issued by the supplier. That is the first and foremost important condition. Second is that the goods or services or both should be received by the recipient from the supplier. The tax which is charged by the supplier and collected from the recipient must be deposited to the government, and the monthly return in GSTR 3B needs to be filed. So these are the 4 primary conditions. We'll discuss the secondary conditions as well in the next slide. So these are the special conditions or special scenarios. The first one being that if any procurement has been made from any vendor, the payment to the vendor needs to be made within 180 days from the date of issue of invoice. In case the payment is not made within a period of 180 days, the credit pertaining to such procurement needs to be reversed. We have covered this in detail in the subsequent slide, so we'll discuss in detail in the subsequent slide. The second condition is that ITC for a particular financial year can be claimed only till the due date of filing the September month return of the following financial year or date of filing annual return of that particular year, whichever is earlier. So if we are talking about financial year 21-22, we are looking at a due date which is filing September 2022 return or filing annual return of financial year 21-22, which is 31st December 2022, whichever is earlier. So that's the due date. Now, in case of goods which are received in lots or installments, ITC can be availed only on receipt of the last installment. So you'll have to wait till you receive the last installment. Now, in case of capital goods and plant and machinery, ITC cannot be claimed on the depreciation component. So in case if on the CGST, SGST or IGST component, already a depreciation has been claimed under the Income Tax Act, then ITC cannot be availed. So either you claim ITC or you claim depreciation on your tax component. You cannot have both the benefits. We can move on to the next slide. Okay, as I had earlier said that one of the most important and primary conditions is that a person claiming ITC needs to have a tax invoice in place. Now, a tax invoice format and the contents of tax invoice are defined under the GST rules. However, there are various contents which are prescribed under the GST rules. In order to give some relaxation to the recipient, with effect from September 4, 2018, the government has allowed a registered recipient to avail input tax credit, even if the tax invoice or debit note or any other tax paying document has 5 basic contents, which are amount of tax charge, which is the obvious thing. The next one being description of goods or services, total value of supply of goods or services or both, GSTN of the supplier and recipient, and place of supply in case of interstate supply. So if it is an intrastate, you need not have the place of supply. If it is an interstate, like a supply between Karnataka to Maharashtra, then you will need to mention the place of supply. So this is a relaxation and this is still available. We can move on to the next slide. Okay, this is one of the most important things, which is reconciliation of your input tax credit, which is appearing in your purchase register books with GSTR 2A 2B. Now, the entire GST law was formulated with the idea of matching concept, that whatever your suppliers are filing, that should reflect in your GSTR 2A 2B, and basis that the return and the computation needs to be done. However, various technical glitches, initially, the GSTR 2A filing was not brought into effect by the government. So in financial year 17-18 and financial year 18-19, to be very specific, till September 2019, it was not really necessary for the registered persons to undertake any GSTR 2A 2B reconciliation. They could avail ITC basis the conditions which we have discussed above, which is the basic conditions and the secondary conditions. However, with effect from October 9, 2019, the government introduced Rule 36(4) and restricted the availment of ITC to the extent of those invoices which are reflecting in 2A, 2B of the registered tax person. So we'll, in the next slide, just see how Rule 36(4) has evolved over a period of time. We can move to the next slide. Okay, so with effect from October 9, 2019, when the rule was firstly implemented, the government had said that matched ITC can be completely taken by the registered person and unmatched ITC can be taken only to the extent of 20% of the matched eligible ITC. Now, with effect from January 1, 2020, that was reduced to 10%. With effect from January 21, the 10% was further reduced to 5%. And finally, in January 2022, the taxpayer is allowed only to claim ITC to the extent of all the matched invoices. So if there is any unmatched invoice, the ITC pertaining to those unmatched invoices cannot be availed by the registered tax person. Moving on to the next slide. So here we have just given a very small instance of how the ITC was until December 31, 2021, and how it is from January 1, 2022. So eligible ITC in my purchase register, say for example, is 1 lakh. Eligible ITC available in GSTR 2A, 2B, which is my match credit, is 60,000. Then until December 31, 2021, I could have claimed 60,000, which is matched, and unmatched will be to the extent of 5% of my match credit, which is 3,000. So the total ITC which I could have claimed was 63,000, and ITC which was not allowed was 37,000. Now from January 1, 2022, it can be claimed only to the extent of match credit, and hence I can claim only 60,000. There is no portion of the unmatched credit which I can claim from January 1, 2022.
So does that make reconciliation absolute must?
Yes.
Right?
So reconciliation is an absolute must now for taxpayers because, and again, since the reconciliation is compulsory, there are notices which most of the taxpayers are receiving if there is a mismatch in the credits. So as we had earlier discussed that ITC needs to be reversed in case if the payment is not made to the supplier within a period of 180 days. So in this case, ITC availed will have to be reversed. Again, there will be an interest liability at 18% from the date of availing such ITC till the date of adding it to your output tax liability. So by reversal, I mean that you have to add your ITC component to your output tax liability and pay it. Now, the moment you pay to the vendor, the reversed ITC can be reclaimed. And for reclaiming, there is no time limit of September or December annual return, which is applicable in case of original ITC. That will not be applicable for your re-availment of ITC. And this provision, of course, will not be applicable to transactions between related parties because transactions between related parties are considered supplies even without paying any consideration under GST. We can move to the next slide. Any questions so far, or should we take all the questions towards the end?
Or are they good? If there's, I mean, are they with you, or is the speed okay? Slower, faster?
Yeah, so if everyone is with me, I can move on, or if there are any specific questions or you want me to slow down, I can do that.
I think you can go on, Isha, and later on
Okay.
we can take all the questions.
Okay, sure, thanks. So now block credits, we have divided it into two parts. One is based on usage and second is on the nature of transactions. So when I say on usage, I mean to say that ITC can be availed only if it is used for the purpose of business. So if I'm using any goods or services, partly for business purpose and partly for other purpose, I'll have to restrict my ITC only to the extent I use it for my business purpose. Now, there are taxable supplies and there are exempt supplies. By taxable supplies, I mean that GST is chargeable on such supplies. By exempt supplies, I mean that these are nil rated supplies, or these are exempted by way of some exemption notification, or they are outside the purview of GST. So in this case, since no GST is charged on outward supplies, I cannot avail ITC, which I am using for making such outward supplies. Since there is no GST on outward, you will not get any ITC on input supplies as well. Now, the last thing is very specific to banking companies and NBFCs. Now, banking companies and NBFCs generally provide services which are taxable as well as exempt. Exempt being interest on loans, deposits, etc., which are outside the purview of GST. So they have an option to follow either the actual method of computing input tax credit, which is used for taxable supplies as well as exempt supplies, or they can claim 50% of the eligible ITC on input capital goods, input services every month without computing what is the actual ITC towards taxable supplies and actual ITC towards exempt supplies.
So
But
does
this
it apply to exports as well, or is that something which is works differently? I mean, export is not an exempt supply.
no,
but
yeah.
So how does export, input tax credit paid for goods that are exported? How does that work?
Okay, so exports will not be considered as exempt supplies. Exempt supplies particularly mean supplies which are nil rated or which are exempted by way of an exemption notification. Now, exports are not exempted. They are zero rated supplies. They are given a special status of zero rated supplies under GST. Accordingly, any input tax credit which is used for the purpose of making zero rated supplies or export of goods or services, input tax credit in relation to those supplies will be available. In fact, you can even go ahead and claim a refund, because on your exports, you'll not be paying any tax and there will be accumulation of credit in your electronic credit ledger. So we can move on. Shabnam. Okay. Now, these are block credits based on the nature of procurement. So, input tax credit in relation to motor vehicles, procurement of motor vehicles for transportation of persons having approved seating capacity of not more than 13 persons will not be allowed. It shall be allowed only in the following three cases, where the motor vehicles is used for further supply of motor vehicles, or it is used for transportation of passengers, or it is used for imparting training on driving. When it comes to procurement of vessels and aircraft, the ITC will not be allowed except when it is used for further supply of vessels, aircraft, transportation of passengers, imparting training, or transportation of goods. Now, services of general insurance, repairs, maintenance relating to such motor vehicles, vessels or aircraft will also not be allowed except when they are used for the purposes prescribed, or they are received by a manufacturer of such motor vehicle, vessel or aircraft, or it is received by a taxable person who is engaged in supply of such general insurance services. Only in these three cases, ITC shall be allowed. We can move on to the next slide. Okay, now ITC in relation to food and beverages, outdoor catering, beauty treatment, cosmetic and plastic surgery, health services, leasing, renting or hiring of motor vehicles, life or health insurance shall not be allowed. Now this shall be allowed only if a particular person is providing outward taxable supplies under the same category. Membership of club, health and fitness center, Travel benefits extended to employees on vacation, ITC relating to these will also not be allowed unless it is provided by the employer to the employee by a mandate under any law, then it shall be allowed. When we talk about works contract service, which is in relation to an immovable property, it will not be allowed. It shall be allowed only if it is used for further supply of works contract service. So if my business is providing works contract service, I can avail it. Otherwise, I cannot avail works contract service supplied for construction of any immovable property. If I am using any goods or services for construction of an immovable property, ITC relating to the same shall not be allowed, and it shall only be allowed if it is used in construction of a plant and machinery. So plant and machinery is the only exception. Apart from that, any other immovable property constructed shall not be allowed. Now, goods and services on which tax is paid under composition scheme. So what do I mean by composition scheme? There are special dealers whose aggregate turnover for a particular financial year is not exceeding 1.5 crores. They can apply for composition scheme, and such composite taxpayers need not collect any taxes. They pay taxes at a blanket rate of 1% or 5% on case-to-case basis, and such taxpayers do not issue tax invoices. They issue bill of supply. So there's no input tax credit. Accordingly, you cannot claim any input tax credit on procurements from such composite taxpayers. If you're a non-resident taxable person, and if you're receiving any goods which are not imported but which are procured in India, then ITC will not be allowed. If there are any goods which are used for personal consumption of employees, or say they are lost, stolen, destroyed, written off, or disposed of by way of gift or free samples, then again ITC will not be allowed. We have covered certain instances in the next slide, so we can quickly go through those instances. Say a partner of a firm is taking membership of Lions Club. Since it is a membership fee, the ITC will be ineligible. An employer is providing life insurance services to its employees, then that will be ineligible. If there is a business trip of an employee and that is further extended as a vacation, then ITC and expenses incurred for business trip will be allowed, but for personal vacation shall be ineligible. Vehicle purchased by driving school to provide training, that shall be eligible because it is a driving school. Repairs and maintenance of vehicle used for driving school, that again will be eligible. General insurance of motor vehicle purchase for personal use. Now this is for personal use, so it will be ineligible. Moving on to the next slide. Okay, yeah, so this is a non-resident taxable person. So a non-resident taxable person is conducting an exhibition in India. In that case, if any procurement of jewelry is made in India, that will be ineligible. But if there is anything imported from outside the country, that will be eligible. If ABC Limited is using outdoor catering services, again, since it is relating to food and beverages, it will be ineligible. Beauty products purchased by a salon will be eligible, since the salon will be in the business of supplying such products ahead. But if it is by any other company or partnership firm, the same will be ineligible. XYZ Limited distributed gold coins to employees as gift, it will be ineligible because anything given as gift or free samples is not allowed. ABC Limited hires a rent-a-cab to provide transportation to its female staff on night shift. This will be eligible, assuming that the government has passed a rule that it is mandatory for employers to provide such services. If it is not mandatory under any law, this will be ineligible. We can move on to the next slide. Next slide, please. Next slide. Yeah. Now, there were two rulings on distribution of common employee costs incurred in head office. So as all of y'all would be aware that under GST, each registration is considered as a distinct person. Therefore, if I have my head office in Maharashtra and I have branches across various states, say Karnataka, Gujarat, etc., each registration will be considered as a separate entity under GST. And at the head office, there will be common employee expenses like HR, accountant, which will be incurred. Now, the salaries of these employees is definitely paid by the head office, but these functions which are provided by these common employees will be for all the branches. Accordingly, under GST, the ruling which has been passed states very clearly that the employees are providing services to the head office, and the head office is in turn using these services for its various branch offices, which are distinct persons. Accordingly, there is a supply which takes place between the head office and branch office, and accordingly, the common employee cost needs to be distributed by the head office to its various branch offices. So there were two rulings. One was in Karnataka, which was the Columbia Asia Hospital Private Limited case, and in Maharashtra on Cummins India Limited, which was recently passed. The premise and the outcome of both the cases was same, that common employee cost under GST needs to be distributed by the head office to its various branch offices. We can move on. Okay, now transitional credit. Transitional credit, are you okay? Any
Is okay.
speed is okay? Sharma, is my speed fine? Is there any questions, or should I slow down?
Yeah, hi. Sorry.
Okay,
The
then I'll
speed is
move on.
fine. Yeah, the speed is fine.
Okay, fine. Now we talk about transitional credit. Transitional credit, as the name suggests, is credit pertaining to the erstwhile regime, service tax, VAT, excise, which can be transferred to the GST Act. Now, this credit can be transferred by filing two forms, which is Tran 1, Tran 2, and the credit will reflect in the electronic credit ledger of the registered person. However, due to technical glitches, many taxpayers could not file Tran 1, Tran 2 on time. And that is why these taxpayers filed writ petition in different high courts, because they were deprived of the credit which rightfully belonged to them in the erstwhile regime. So the Supreme Court recently passed a ruling, which I've discussed in the next slide. Which said that taxpayers who could not file Tran 1, Tran 2 due to technical glitches can now do so, because the window is open between September 1, 2022 to October 31, 2022. Now, then a period of 90 days will be given to the officers to verify the claim. If they have any questions, they can ask the registered taxable persons. And if there are no questions, then the credit will reflect in the electronic credit ledger of the registered assessees.
So is this something, sorry to interject, but I just thought that maybe it's a little, because at the end of the day, as we said, CGS input tax credit is cash, right? So the question really is that, if this transitional credit provision is something which is available, and it is still open for me to file that claim, because I think the timeline is extended to 31st of October 2022.
Right.
So I guess, each one of us may want to review if you are eligible for any transitional credit. I mean, given you all are startups, I'm assuming that it will be relatively, all pretty much within the 1 to 3 year regime. But if you have been set up prior to 2017, I think the question of whether you can claim your transitional credit is critical.
Yes.
Right. And that is something which you all should review internally. Isha.
Yeah. Yeah. So this provides a golden opportunity to all taxpayers who could not file their transitional credit forms. Now, for taxpayers who want to amend, of course, there's no window open. It is only for those who could not file it for technical reasons or any other reason. So yeah, this was pertaining to transitional credit. We can move on. So we have covered the slides pertaining to input tax credit. Now we come to GST compliances. Under GST compliances, we have covered the following topics. We can move on to the next slide. Yeah, GST registration. It will comprise of both the things, compulsory registration and threshold limit crossing registration. Types of GST returns, the quarterly return and monthly payment scheme for small taxpayers, order of utilization of my input tax credit, payment of tax, and interest on delayed payment of tax, and transfer of amount in electronic cash ledger. Now, this transfer of amount in electronic cash ledger was something which was recently brought into effect by the government, and this is actually useful to many taxpayers. So we'll discuss it in detail. Firstly, we'll cover GST registration. Now, GST registration, we can move on to the, as per the old limits, the GST registration for goods and services for normal category states was, if my turnover is exceeding 20 lakhs, I need to apply for GST registration. For services, it was again 20 lakhs, but for special category states, it was 10 lakhs. Now, with effect from 1st April 2019, the limits were revised. And for the states of Mizoram, Tripura, Manipur, and Nagaland, the limit was 10 lakhs for goods, 10 lakhs for services. For Arunachal Pradesh, Meghalaya, Puducherry, Sikkim, Telangana, and Uttarakhand, it is 20 lakhs for goods and services both. For Jammu and Kashmir, Assam, Himachal Pradesh, and all other states, it is 40 lakhs for goods. So it has been increased by 20 lakhs. And for services, it is 20 lakhs. Now, compulsory registration. So compulsory registration is required for businesses crossing the threshold limit, which we have already covered above. If there is interstate supply of goods or services or input service distribution, then again, there is compulsory registration. For services, again, the government has brought a relaxation and stated that if your threshold limit is not crossing 20 lakhs, you need not apply for GST registration in spite of you making interstate supply of services. But for interstate supply of goods, it is mandatory irrespective of the threshold limit. If one is a casual taxable person or a non-resident taxable person, then GST registration is mandatory. If there are supplies for which GST needs to be discharged under reverse charge mechanism, then registration is compulsory. If you are an e-commerce operator or a person supplying through e-commerce operator, then GST registration is compulsory. Now, e-commerce operator also, in case you are an e-commerce operator who is required to collect TCS, then only the registration is mandatory. If you are a TDS deductor or a TCS deductor, which is equivalent to being a TCS deductor, means an e-commerce operator. If you are an agent of a supplier, or if you are a person supplying online information and database services or retrieval services, in all these cases, GST registration is mandatory. Now we have just covered some important returns, which are GSTR 1, 3B, 9, 9C. 1 is basically your statement of outward supply of goods or services. 3B is a monthly computation of outward tax minus your ITC claimed and payment of tax return. GSTR 9 is the annual return, which is nothing but a compilation of all your GSTR 3Bs. And GSTR 9C is a self-certified reconciliation statement, which is a reconciliation between your GST returns and your audited books of accounts. So, yeah. Now, GSTR 1. GSTR 1, as I said, is a statement for all your outward supply of goods or services, and it is a monthly, quarterly return that needs to be filed by every registered person. Even if it is a nil return, you will have to file your GSTR 1 if you're registered under GST. Now, we have just briefly covered the contents of the GSTR 1. So table 4, which is the first table, comprises details of all your outward supplies to registered persons. So if I'm making any outward supply to another registered person, I'll be mentioning the invoice-wise details in table 4. if I'm making outward supplies to a person who is not registered under GST, and if my invoice value is exceeding 2.5 lakhs, I'll be mentioning it in table 5. The only relaxation here is that invoice-wise detail need not be given. You can club all the invoices depending upon the place of supply. So to say, if I am supplying to customers located in Karnataka, I can club all those invoices and mention here in table 5. Table 6 pertains to details of exports, supplies made to SEZ or deemed exports. If I am making taxable supplies to persons not registered under GST and whose invoice value is not exceeding 2.5 lakhs, then I have to mention it here. Exceeding 2.5 lakhs goes in table 5 as already earlier discussed. If there are certain exempt supplies, non-GST outward supplies or nil rated supplies, they need to be reported in table 8. Non-GST outward supplies mean supplies which are not bought under the purview of GST, like petroleum products. They are still outside the purview of GST. Exempted means interest on loans deposited by a banking company. Those are exempted, so they will be reported here. Now, if I have to make any amendments to outward supplies which I have reported in my earlier returns, I have an option to do so, and that I can do it in table 9. But the time limit to amend any invoice will be till I file the return for the month of September of the subsequent financial year. So for financial year 21-22, I can amend invoices only till the due date of filing GSTR 1 of September 2022. So this is for B2B. Table 10 will again be for B2C, which is supplies to unregistered taxable persons. The time limit of September will be applicable to both registered as supplies to registered as well as unregistered persons. If I have received any advances, now GST is applicable on advances in case of goods. So if I have received any advances, I'll report here. If I have adjusted any advances, that also will be reported in table 11. Table 12, I give a HSN-wise split of all my outward supplies. The HSN-wise split is based on my aggregate annual turnover. So if my turnover is only up to INR 5 crores, I have to give HSN code digit till 4 digits. If my turnover is more than 5 crores, then I'll have to give a 6-digit HSN code reporting of my outward supplies. Table 13 is documents issued. Basically, the invoices which I have issued, the debit notes, the credit notes. If I have cancelled anything, I have to give a series-wise information reporting in table 13. So that is GSTR 1. Now moving to GSTR 3B. GSTR 3B is nothing but a monthly return which will be a computation of all your output tax minus your input tax credit, which will give you your final GST, which is required to be paid in cash. So outward supplies detail are auto-generated from GSTR 1. In case if there are certain details which are inadvertently not reported at the time of filing your GSTR 1, you can include it in your GSTR 3B so that you avoid payment of interest, because through 3B you pay your taxes. So in case if you have not reported something, it's important that you include in your 3B so that there is no interest levy at least. ITC, as I said, first you'll have to see what is the ITC which is available to you as a business, because there are block credits, there are credits which may be pertaining to goods or services used for exempt supplies or for personal purposes. All such ITC need to be deducted and only the eligible ITC needs to be taken into consideration. Then there are certain goods or services on which you as a registered person are required to discharge GST under reverse charge mechanism, say sponsorship fees or legal fees. You will have to compute that ITC. And then finally, you reconcile your ITC with your GSTR 2A, 2B. Now it is 2B. Now the government has made it mandatory that all your input tax credit needs to be reconciled with GSTR 2B. So you do that. which is of utmost importance as we have already discussed. Then you have your ITC in place. And then finally, you compute your tax by having your output GST. You deduct your eligible matched ITC, you have your GST payable in cash, you generate an online challan on the GST portal, and the payment of that online challan will reflect in your electronic cash ledger. You debit your electronic cash ledger and file your GST return. So this is all about GSTR 3B. Now we come to the annual returns, and of course, the persons to whom such annual returns will be applicable. So if your aggregate turnover in a particular financial year is exceeding 2 crores, then you are required to file GSTR 9, which is your annual return. In case the aggregate turnover is exceeding 5 crores, then along with the annual return, you are also required to file reconciliation statement, which is nothing but a statement which will reconcile your returns with your audited books of account. Now, there are certain persons who are exempt from filing annual return and reconciliation statement, which are input service distributor, a casual taxable person or non-resident taxable person, registered persons deducting TDS, e-commerce operators liable to pay and collect and pay TCS. So e-commerce operators also need not file annual return or reconciliation statements. Moving on. So now GSTR 9. So GSTR 9, as I earlier said, is a compilation of all your monthly returns, and that will reflect in your GSTR 9. And GSTR 9 is the last opportunity to pay any taxes or cover any invoices which are not covered during the financial year. So table 4 will have details of all advances, inward and outward supplies made during the year on which tax is payable. So advances, inward supplies on which I'm supposed to pay GST under RCM, and outward supplies. So all these supplies on which tax is payable by me. Then comes table 5, which will cover all details on which tax is not required to be paid. So such outward supplies which are exempted under GST or which are not bought under the purview of GST. Table 6 will have all my details of ITC, input tax credit, which I have availed during the financial year. The next table will have details of ITC reversal and ineligible ITC for the financial year. So this input tax credit computation is done. Once the computation is done, we move on towards the reconciliation, which was not mandatory till September 2019, and now from October 2019, it has been made compulsory. So you do your ITC reconciliation with your GSTR 2A, 2B, as the case may be. And then you have the next table, which will populate the taxes paid as you have declared in your returns filed during the financial year. So it will have all the taxes paid from your electronic cash ledger or from your GSTR 3B, and it will populate the details here. Now, table 10 and 11 are basically additional invoices or amendment to invoices which you have made for this financial year up to September of the subsequent financial year. So, for example, if I'm filing my annual return for the period 21-22, I have time till September 2022 GSTR 1 due date to amend my invoices. So if I have made any such amendments, they will come or get populated in this table 10 and 11.
So again, this is the window that is available to me.
Yes, this is the window.
So again, which is basically an internal review that is required. And if there are additional invoices or if there is any amendment that I need to carry out, then I can do that before September 22.
Yes.
Perfect. Okay.
Moving on to the next slide. Now, table 12 and 13 are only for reporting purpose. They are not, these tables are not impacting your tax liability in the annual return. So table 12 focuses on ITC availed in 21-22, but which I have reversed in the period April 22 to September 22. So it will reflect in my annual return of the next financial year, but I'm just reporting that this ITC I have in fact reversed. I'm not eligible to claim it, and I have reversed it in my subsequent period. Details of ITC pertaining to financial year 21-22 but availed in GSTR 3B of April 22 to September 22. So I have time anyways till September to claim my ITC of a particular financial year. So if for whatever reasons I could not claim it in this financial year and I choose to claim it in the next period, I will just mention it here. It will reflect in my annual return of the subsequent financial year. Now, if I have not made any payment to my suppliers within 180 days and later on I make the payment, but the payment and reclaiming happens in the next financial year, I report it in GSTR 9 of my next financial year. If there is any ITC pertaining to my previous financial year, which is 2021, but I have reversed it in this financial year, I'll report it here in April 21 to September 21. Now, if there is any differential tax paid on account of declaration of amendment in invoices or additional invoices, that will reflect in table number 14. Now, these table 15, table 16, and table 17 are optional. Here, basically, one is supposed to give particulars of demand refunds if there is any supply which are received from composition taxpayers, since you will not be able to avail ITC from such taxpayers. Deemed supply under section 143, basically from your job worker if you're receiving any supplies, or goods sent on approval basis. HSN-wise summary of output supplies. We can move on to the next. HSN-wise summary of inward supplies. Again, HSN-wise summary of inward supplies is something which is optional. The last table being late fee payable and paid. So in GSTR 9, if there is any additional tax liability which arises, then that tax liability can be paid only through cash. You cannot make use of your credit available in the electronic credit ledger, and that needs to be paid in form DRC 03.
When you say cash, this is all banking channels.
Yeah,
right?
all banking channels.
So whenever we report to cash, it's basically banking channels.
Yeah, so by cash, I mean all through your banking channels, and you cannot make use of the credit which is available to you in your electronic credit ledger. Even if there is credit, you have to go through your electronic cash ledger and not your credit ledger.
So that's actually an outflow.
Yes,
It's a fund outflow.
Yeah.
Okay.
We can move on to 9C, which is a reconciliation statement. 9C is divided into two parts. One is your reconciliation statement and other is your certification. When I say reconciliation, your reconciliation refers to reconciliation between your GST returns and your audited books of accounts. So firstly, you reconcile your gross turnover and taxable turnover with your books of accounts. Then you do a rate-wise GST liability calculation. And if there is a difference between your books of accounts and your returns, you give reasons as to why there is a difference. Then you reconcile your net ITC, basically your input tax credit, which you have claimed in your returns and which is available in the books of accounts. Again, if there is a difference, you need to provide reasons for the same. Lastly, you reconcile your ITC expense-wise. Now, this expense-wise breakup reconciliation is something which is optional. If you want to do it, you can do it. If you choose not to report it, that's fine. Earlier, your GSTR 9C was required to be certified by a chartered accountant or a cost accountant. However, with effect from August 1, 2021, a registered person is allowed to self-certify. So to say, the certification can be done by the authorized person of the company, and there's no need of certification from a chartered accountant or a cost accountant. Now, before you file your GSTR 9C, it is of utmost importance that all your other returns, be it from GSTR 1, 3B, 9, for that particular financial year need to be filed. So this was 9C. And now types of GST returns, we have already discussed those types. Now we have compliance due dates. So GSTR 1, the monthly needs to be filed by the 11th of the subsequent period. GSTR 1, if I'm opting for QRMP scheme. So QRMP scheme is basically for taxpayers having turnover up to 5 crores, which we'll discuss in the subsequent slides. Then the due date will be 13th. GSTR 3B, for turnover of more than 5 crores or for turnover up to 5 crores and not opting for QRMP scheme shall be 20th. My GSTR 9, which is my annual return, is 31st of December. And again, my reconciliation statement again is 31st. Now we come to the QRMP scheme. By QRMP scheme, I mean quarterly return and monthly payment scheme. As I earlier said, QRMP scheme is applicable to all small taxpayers whose aggregate turnover is only up to INR 5 crores. Now, for these taxpayers, they have an option to file Form GSTR 1 and 3B on a quarterly basis. However, the payment needs to be made on a monthly basis. So my GSTR 1 under QRMP scheme, I have to file on a quarterly basis. However, there is an invoice furnishing facility which is available to such QRMP small taxpayers, and using the IFF, they can file the invoices of the first 2 months on the GST portal. However, the limit is only up to 50 lakhs. So for month 1, I can file invoices of value 50 lakhs. For month 2, again, invoices of value 50 lakhs can be uploaded on the GST portal. Now, this IFF facility is completely optional. If the taxpayer chooses not to file anything through IFF, but directly report it in GSTR 1, that is very much possible. Now, under the QRMP scheme, GSTR 3B again needs to be filed on a quarterly basis, which is either 22nd or 24th of the succeeding month, depending upon the state which the registered person belongs to. Now, the tax due in the first 2 months of the quarter needs to be deposited. So, as I said, return filing becomes quarterly, but your payment needs to be done on a monthly basis. That payment needs to be done through GST PMT 06. How that payment is to be done, we have covered in the subsequent slide. We can move on. Yeah. So firstly, I'll just cover the benefits and issues under QRMP scheme, and the benefits will determine also the payment method for the first 2 months. So the compliance burden reduces significantly under the QRMP scheme, because you only have 4 GSTR 1 returns and 4 GSTR 3B returns as opposed to 12. Furnishing of your outward supply details in IFF for the first 2 months is also something which is optional and not compulsory. And you can easily opt in and opt out of the QRMP scheme. You can do it during the quarter, and then you can opt out for the next quarter, depending upon your convenience. Also, for a particular GST registration, you can opt for QRMP scheme. For some other GST registration, you can continue with your monthly scheme, depending upon your convenience. So that flexibility is also provided. No payment is required to be made under the QRMP scheme if there is balance in your electronic cash ledger. And in case if you have to make payment in first 2 months of the quarter, there are 2 methods. The first method being the fixed sum method, where a payment of 35% of your cash in the previous quarter needs to be paid, or you go with the self-assessment method, which is actual tax due after adjusting ITC. So fixed sum method for quarterly will be 35% GST paid in previous quarter. If you are filing, if your previous return was not a quarterly return but a monthly return, then you'll have to pay 100% of the cash amount paid in the previous month as provisional tax for the first 2 months. Issues are that you'll have to segregate the B2B and B2C invoices, because under your IFF facility, you can upload only B2B invoices. So you'll have to do that segregation. Now, since there's a limit of 50 lakhs for each month, again, large taxpayers may try to avoid this QRMP scheme, because not all invoices may be uploaded through IFF. So there may be a delay in availment of ITC by your customers. Again, the last thing is prioritization of invoices. You don't know which invoices to apply if you're apply under IFF if your invoices are exceeding 50 lakhs in a month. So that creates a bit of confusion. Now, this is order of utilization of ITC, which is ITC, firstly, on account of IGST, can be used only towards output liability on account of IGST. Then you can use it for towards your CGST, SGST payment in any order and any proportion. And ITC on account of IGST needs to be compulsorily first completely exhausted, and then you can move on to your next head, which is CGST. CGST, firstly, you have to use the input tax credit towards your CGST payment, and then you use it for your IGST. You cannot use your CGST ITC for making payment of SGST output liability. When we come to SGST, SGST, first you have to make your SGST payment, then come to IGST. Now, ITC on account of SGST shall be utilized only for payment of IGST only when the balance of CGST is not available for payment of IGST, which means you first have to make your IGST payment from your CGST account and then you move towards your SGST account. We have covered it in an example in the next slide. So here my output liability under IGST, CGST, SGST is 1,300, 300. My ITC is 1,300 under IGST, 200, 200 under SGST and CGST. Now my IGST payment output liability of 1,000, I'll first knock it off by using my ITC under IGST. So 1,000 is exhausted from there. Then I come towards my output liability on account of CGST. Now I still have 300. 1,300 is my ITC, 1,000 is my IGST output liability. So I have 300. From that 300, 200 first I use towards the payment of my CGST, and balance 100 I use it for my payment of SGST. Now comes my CGST. Now balance CGST amount is 100. So that 100 I pay using my CGST account because IGST is completely exhausted and I cannot make use of my SGST for making my CGST payment. Then I lastly come towards my SGST. The balance amount is 200. Now that 200 I pay using my SGST account. So there is a balance of ITC only in my CGST account at the end of the entire adjustment. So payment of tax. Now, there are two ledgers which are very important, which is the electronic cash ledger and electronic credit ledger. Electronic cash ledger is all the payment of taxes which you have made using your banking channels and which reflects in your electronic cash ledger. Electronic credit ledger is basically your input tax credit which you have claimed in your GSTR 3B, your monthly returns, your eligible matched input tax credit. Now your electronic cash ledger balance can be made, can be used for making any payment towards tax, interest, penalty, fees, or any other amount payable under the provisions of the GST Act. However, the electronic credit ledger can be used only for making output tax payment. It cannot be used for making your interest payment or penalty payment or fees or any other payment. It is only reserved for making your output tax payments. Now, all liabilities of a taxable person is reflected on the GST portal in your electronic liability ledger. Electronic liability ledger basically will have all your credits in your electronic cash and credit ledger and the debit made out of it. So each month you can preview that. Now under GST, the payment modes for making tax payment in cash and not through electronic credit ledger are internet banking, credit card, debit card, NEFT, RTGS, or over the counter. So these are the payment modes which are prescribed. Okay, now this is interest on delayed payment of tax. Interest on delayed payment of tax is on account of two things. One is that if you have not filed your GST returns on time, and hence you have not paid your liability in time, then there will be a interest applicable, which is at the rate of 18% from the for the period for which the tax remains unpaid. Now, this 18% shall be liable only on the payment of GST in cash. So to say that if there is credit available in your electronic credit ledger, then there will be no interest payment. But if there is no credit available in your electronic credit ledger, and if the tax still remains unpaid, which is necessarily to be offsetted from your electronic cash ledger, then the interest liability of 18% will arise. Now, if I have wrongly availed any ITC, input tax credit, which is not eligible to me, say if I have taken, if I have utilized ITC, which was for goods or services which are used for my personal purpose, and I have availed that portion of ITC in my business, then there will, and if I have gone ahead and utilized such ITC, then there will be a interest liability at the rate of 24% for the period of usage of such ITC. Now, this was an important amendment which was brought by the government, which is transfer of amount in electronic cash ledger. So if I have 10 GST registrations, and if for 8 GST registrations, I have some excess balance in my electronic cash ledger, and for 2 GST registrations, I need to make payment in cash, payment of tax in cash through my electronic cash ledger, then I can transfer from those 8 GST registrations the balance in my electronic cash ledger to the 2 registrations where I actually need to make payment through my electronic cash ledger by filing a simple statement, which is GST PMT 09 on the GST portal, and avail that benefit of transfer of cash from one electronic cash ledger to another electronic cash ledger.
So it's all fungible.
Yeah, so
It's
they
fun-
made,
Yeah, so they made it all fungible, which is a good thing,
yes,
because otherwise, it has an impact on the cash flow.
on the cash.
And is there a time limit within which I need to file
No.
this GSTR?
No, there's no time limit to file such statements, and the objective of the government, as Rajshri rightly pointed out, was making the entire cash flow fungible for the assessors.
Thank you.
So yeah, we can move to the next slide. If there are any questions, I'll be happy to answer those.
Members, we are open for the questions.
The laptop is also okay. You can go there. Yeah.
So yeah, you can raise your hand, and we can unmute and you can ask your questions to the speaker.
There's one question on the chat, Shabnam. I think the question is, I'm director of a company. Can I avail ITC on office expenditure? In this case, when you say, it's basically the company is the registered assessee out here. So the answer is the company can definitely avail ITC, subject to all these expenses are being incurred for the purposes of business.
And not being.
Yeah.
Hello, can I ask my question?
Yes, please.
Yes, I have this question in 2 parts. One is, if within the state where I'm registered, if I'm incurring expenses when my employees travel within the state to some other town or a city, and they incur travel expenditure like hotel accommodation and food on work-related travel, is the GST on that, can I claim input credit on that? As compared to when I'm traveling to another state where I've not registered, and then would I then be able to claim input credit? Work-related travel.
Yeah, so for food-related expenses, of course, the ITC is restricted, so you cannot claim ITC on food and beverages. Now, when it comes to hotel stay, there are 2 parts. One is it is within a state where traveling to a state where you are not registered, since it is CGST, SGST of that state where you are not registered, that credit will not be eligible and it will lapse.
Okay, so the food expenses, whether I'm within the registered state or outside, food
Food
on official
expenses
travel is not allowed, is it?
irrespective. Okay, so food expenses irrespective of whether you are situated in the same state or some other state will not be allowed, because food and beverages, ITC pertaining to food and beverages is categorically, restricted under GST. So that will not be allowed.
Okay, thank you.
There's one more question in the chat. How to get refund of ITC against service export?
So zero rated supplies is what we are referring to here. So any export of service, you have to qualify, you have to firstly adhere to certain conditions, and I'm assuming that those conditions are adhered to. And then when you have export of services, there are two ways of claiming refund. One is that if you have a LUT, then on your export of service, you will not charge any output IGST. If you have a LUT, then you are not supposed to charge any output IGST, and then your ITC, basically your input tax credit, will be accumulated. So you can claim a refund of the accumulated ITC by filing GST RFD 01 on the GST portal. The second is, if you do not have LUT, then you have to pay IGST on the outward supply of such export of services, and then claim refund of such output IGST by again filing form RFD 01. So I hope that answers your question.
And LUT basically, so if I were to just take this a step further, when I submit my LUT, say, and when we say LUT is letter of undertaking, the letter of undertaking, if I have indicated, do I have to indicate the value of exports that I'm going to be? I don't have to.
No.
Is it more like a bond?
It's not like a bond. You just you can be eligible to file a LUT if you have not done any tax evasion of more than 2.5 crores.
Sure. And the LUT, basically, all I'm saying is that I am engaged in so-and-so service, or, manufacturing so-and-so goods, and I will be engaged in exports, and I don't need to give a value. That's all.
No.
Right? Okay.
Hello. Hello.
Yes, go on.
Madam. Can we avail the IGST against the service rendered to us in another state where we have not registered ourselves?
Okay, so what you're saying is you are rendering services in a state where you are not registered.
Yeah. No, we are not rendering. We are availing services.
You are availing, sorry. Okay, you are availing services from a state where you are not registered, obviously. So that means, but the person who's providing the services is a registered GST.
Yeah, they are registered. Okay. But suppose, for example, I will give you, we are based in Mumbai, Maharashtra.
Yeah.
Our office is in Kolkata. Okay. Now there some AC services are given.
AC services.
AC repairing services.
AC repairing services.
Okay.
And they have charged us the IGST.
Okay, they've charged you IGST. Okay.
Another
the question is whether you can claim that against your liability.
So, madam, another example, we have availed the security service. We have kept the security in our office.
Okay.
And they are charging us the IGST. So can we avail this IGST?
Okay, so I'm considering the second example, right? Or should I even consider the first example?
Okay.
If I consider the first example, that you have availed some AC repair services in your Kolkata office, and if you want to claim ITC of that cannot be claimed because your Kolkata office is not registered only. So if that office is not registered, you cannot claim any expenses incurred for that office in your Mumbai registration, because Kolkata and Mumbai, they are in, of course, two different states. So that will not happen. Now, to answer your second question, if you have availed any security services from a security agency which is not situated in your state, and it is situated in some other state, and if they are charging IGST on that invoice in the name of your Mumbai office, you can claim that ITC.
Okay, if they bill in our Mumbai office, then we can claim the ITC.
Yeah, yeah.
And likewise, for the goods also we can claim the ITC. Not services, for the goods. If any purchase of any goods from Calcutta and they bill to our Mumbai office, we can claim the ITC.
Yeah, so basically you are saying your vendor is in Kolkata and he is sending you the goods from Kolkata to Mumbai.
Supplying the
Then,
goods to Kolkata office only. Supplying the goods to Kolkata office only, but then
The actual shipment is going to Calcutta, but your invoice will be on the Mumbai office.
so it is a bill to ship to transaction, right?
Yeah.
Yeah, so in that case, your so basically it is there are two transactions involved here. First transaction is the vendor supplying goods. I'm assuming the vendor is also in Kolkata. Vendor supplying goods to the Kolkata office and billing to Mumbai office, right?
Correct. Yeah.
And
That
In
is
that
they
case,
charge us the
your
IGST.
sorry.
And they charge us the IGST.
Yeah, because you are the billing person in
Yeah,
that case,
correct.
right? But then when your Kolkata office is transferring, so your Kolkata office has not obtained any registration under GST?
No, madam.
Sorry?
No, madam. We have not obtained the registration in Kolkata.
But that is required. And have you obtained registration for your Mumbai office because
Yes.
your turnover is exceeding the prescribed limit under GST?
Correct. Yeah, we have obtained the registration in the Mumbai.
Okay, so
Maharashtra, yeah.
under GST, it works PAN-wise. When it comes to registration, if your PAN India registration is exceeding 20 lakhs, then whenever, or 20 lakhs or 40 lakhs, as the case may be, then you have to obtain registration in every state.
Is it
It is mandatory.
compulsory? Yeah, mandatory.
It is
Yeah,
mandatory.
registration.
So, firstly, to your Kolkata, so this bill, the
Yeah,
billing by
yeah,
your vendor is
service
correctly
industry.
done, that it will be IGST, but then there has to be a stock transfer invoice which has to be raised by your Kolkata entity onto you while they are transferring the goods physically to your Mumbai office.
No, they are not transferring the goods physically to Mumbai office. They are buying the goods for themselves only. We
Okay.
are into export of the service industry. We are into export of services. We are
Okay.
we are into e-commerce business
Okay.
and having main office in Mumbai,
Okay.
Maharashtra. And we have the branch office in Kolkata as well as Bangalore and Delhi.
Okay.
And if any purchases are made in those locations, but we are not registered over there. We are registered in Mumbai only. But they purchase, if we purchase any goods over there, can we claim the IGST for that?
No, you cannot, because that is pertaining to your Kolkata office. You cannot claim it. And firstly, even before I go to the availment of ITC, it is of utmost importance that your Kolkata office is also having a separate GST registration, because you are undertaking business activities from that location.
Okay, but we are not registered over there. And we ask those vendor to bill to our Mumbai office. Is it okay?
Yeah, but your goods are physically going there, right? To Kolkata office. See, billing to Mumbai address is not wrong, but there are two legs which we cannot, ignore.
But what happens to the goods from your Calcutta office? What do you do? I mean, are you in the B2B space or are you just stocking the goods in Calcutta?
No, we buy the goods for to running our office over there. Suppose we buy some air conditioner, we buy some fridge for our office, we buy television, we buy laptops, and they charge us the.
Would it be right to say it's just an administrative office in Calcutta?
Correct, right.
So it's only an administrative office in Calcutta. There is no actual business that is taking place from there, but you have a vendor, obviously. Okay. So therefore you have your normal consumables plus normal office expenditure, which is being incurred for your Calcutta office. The billing for all of this is done by a vendor on the Mumbai office. They are charging IGST. And your question is, can I claim that IGST against my, can I get input tax credit?
Correct.
Why not?
You can, but again,
It's just an admin office in Calcutta.
But that admin office, so again, coming to the common employee cost and the head office, branch office transactions under GST. So even if your Kolkata office, we take it as an admin office, that admin office is actually supporting the Mumbai office, right?
Right.
And in that sense, the Kolkata office is providing some services to the Mumbai office. So all the more reason that your Kolkata office is registered under GST, and for whatever support services it is providing to Mumbai office, some value is assigned to it and GST is charged on that value and billed to the Mumbai office.
Right.
In this way, your entire input tax credit, which is accumulated in your Kolkata office, will be transferred to Mumbai office once you do a cross charge.
Okay.
Assuming the amounts are substantial, because if they're not, I think that's something which you will weigh in terms of whether your compliance cost for getting that registration in Calcutta is much more as compared to the losing of the input tax credit. Okay, that's a business call. It's a commercial call.
Yeah. Sure.
Right?
Hello.
Yeah,
Yeah, okay. So there is, Shabnam, there are two questions on the chat. I think we should just quickly address that.
I think there is another girl who has raised the hand, Pallabika. We'll take her question. She'll just ask.
Pallabika, okay, fine. Let's do
sure.
that. Yeah.
Hi, ma'am. The thing is, we have an online portal through which we sell our finished products like cookies and all. And we also sell through FirstCry and as an e-commerce platform.
Right.
Okay.
So my question is, we end up paying a huge amount of GST because of which, as we are shipping all across India. Okay, and the purchase factors. So for instance, the packaging, if it comes from Bangalore, then we are able to nullify it. Other than that, I'm not able to nullify anything. Can you suggest anything where we can reduce the GST amount any ways possible? One question is that. Second, I see the e-commerce brand also charging me a tax while I'm selling with them. And again, I am paying an amount to the government also on the same sale. So I wanted to understand how can we...
Okay, so to answer your second question first, because that will probably help you understand the structure. So your e-commerce operator, say FirstCry, is charging something known as TCS. It is collecting TCS from you, right? Now, this is not a double tax because once it collects TCS, it will file returns and that TCS credit will automatically reflect in your electronic cash ledger, which you can use while making your GST payment while filing your GST return. So it is not double tax.
Okay. One question, because I have opened their advice slip, is that there's nothing mentioned it's TCS, but SGST and CGST.
So this is CGS. So who is raising the invoice when you're selling on FirstCry? Is it your GSTIN which is reflecting on the invoice?
I won't be aware of that.
So maybe you can.
So basically, I'll just tell you that under. Can I?
Yeah, go ahead.
Yeah, under commerce, there are two models, which is one is the inventory model, which I'm sure is not the case in your is not the
Yes.
case for you, where you are selling your products to First Cry and then First Cry is
No, 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 no.
yeah. So in your case, it will be the marketplace model. So now when I say marketplace model, you are using First Cry only as a market platform to sell your products. So
Correct.
in that case, whatever invoice is raised, that invoice should be in the name of your entity, and you should be charging CGST, SGST to your final customers, which you will discharge to the government. Your First Cry cannot charge any CGST, SGST to you unless they are charging some amount of commission for providing these services. Then on the commission amount, they will be charging some CGST, SGST, and they will be deducting TCS from your consideration. So the consideration which you receive from First Cry towards your supplies will be little less, because they would have deducted commission if they have charged any, CGST, SGST on that commission, and also a portion of TCS. So you'll have to, probably share the invoice copy, or I don't know how we'll get in touch, but you'll have to do that for me to determine that what is the CGST, SGST amount are you referring, which you are referring to. Ideally, it works this way.
Okay.
That First Cry will never charge CGST, SGST on sale of your products to its final customers. That will never happen. If there is a CGST, SGST amount, it is basis the commission which they have charged to you for the services which they are providing.
Okay. And the first question?
First question, how can you save on GST?
Yes. Because it's an exorbitant amount that I'm paying every month. And there are a lot of people who nullify, and I want to understand where I'm doing mistake and
so probably in your case, you are charging GST on your outward supplies, but there are inward supplies, right? There are some services or some goods you might be procuring for making your product, right? So are you claiming ITC on all of it?
Yes, we are, but somehow I don't know why is it not happening, because see, whatever we claim as a raw material has to be from Bombay itself. So that's why for IGST claiming also, it's only the packaging that comes from Bangalore. Rather than that, we don't, and that's also once in 3 months or something like that.
Okay.
So that's why we was trying to understand how can we do. And
so maybe can we take this offline, ask her to get in touch?
Yeah.
Would it be possible?
Sure,
And
sure.
Shabnam, if that's also okay with you, share your documents, share what you, your specific question. We will help you. So, you basically, if you can share, maybe
your sales and purchase details, your supply chain details, then I'll be able to determine that, what can be unlocked, what credit can be unlocked for you, and how we can plan it for you.
That definitely can be done.
Sure, Isha. So what we will do now, we will share like any number which you will give it to us. We'll share to our audience, because lots of them are asking questions. They want to ask offline also.
Okay.
Yeah. So if you could share some email ID or contact number, which we'll put in the chat.
Yeah, I will.
Shabnam, it's there on the last page of the PPT. Email ID is there, but we will share the telephone numbers as well.
Yeah,
okay.
Yeah.
Isha and Nidhi, both their telephone numbers will be shared.
Okay, perfect. So next question.
We'll put it on the chat, Shabnam, or will we share it with you? We'll put it on the chat.
Yeah, put it in the chat. That's better, because they will.
Okay.
Yeah.
Isha Jain and Nidhi. Yeah.
And we'll take next question. Next question is from Aska. Aska, can you ask your question?
I just asked earlier, because we are buying a lot of office expenditure like laptops, printers. Can we claim ITC on that for our office use?
Office expenditure.
Yeah, that is laptops and everything will be allowed as
solely for our office use. That's
only if it is for your office use, then you can claim it.
Yes, I had a doubt. Thank you. That's what I was.
Yeah.
Thank you, Aska. Yeah, Deepti, can you go ahead?
Yeah, hi. So basically, we have a food franchisee business.
Okay.
In Mumbai.
Okay.
But as I saw in the PPT, so I did not know before that we cannot claim ITC on this.
No, but you have. Okay.
Okay.
So You
But we have been claiming ITC from the last 1.5 years.
Yeah, because no. So see, I think there is some this thing disconnect. Basically, if you are in the business of providing food and beverages, then input tax credit and food on food and beverages will be allowed to you. But say I am into the business of providing consulting services, and if I am providing any food and beverages to my employees, I cannot claim ITC on that because I am not into the business of providing food and beverages. But if you are into the same line, then of course you can claim ITC.
So basically, I can claim it ITC, right?
Yeah. You can.
Okay.
You
okay.
can.
Done. Thanks.
Thanks. Yes. There is another question. There is someone from iPhone who has joined in and raised hand.
Okay.
I think the person just okay. I'll just ask. Yes.
Yeah, I have a short question.
Go on.
Hello. Yeah, this is on LUT where you all referred to that. Is LUT is it applicable only for the full financial year, which is April to March, or 1 year from any time we apply?
No, it is for the full financial year. It is for financial year. So even if you apply, say June 21, it will be applicable only till March 22. It works financial year wise.
So if I've missed to reapply again in this April now, I have refunds because of export of services.
Agree.
So will I be able to claim for that? From April till now?
Before filing for your refund claims, you will have to apply for LUT, and then probably you can explain this to your officer. It works on case-to-case basis, but mostly it is considered a small error, which for which they will not reject your refund claim. But before applying for your refund claim, you should have your LUT in place.
So every year on 1st April, we have to apply for LUT.
Yes.
Yes. Okay. Thank you.
Yeah.
Thanks, Isha. So we do have few questions under chat.
I think there's one question on the chat, which is we've answered most of those. There's one around TCS. Nidhi is answering. Just scroll up. There's one around expenses. Just scroll up. No, scroll up. Above. Further. This one. No. We've answered that. This one. Can we claim ITC on travel booking expenses? ITC and GST, it is as per the tax invoice.
Yeah, if your travel expenses is for the purpose of business and not for personal purposes of employees, then definitely this can be claimed.
And the last question is around the TCS. So, yeah.
Please explain about
TCS applicability and how to claim. This is the e-commerce.
Okay. So basically, TCS is applicable if supplies are made through an e-commerce operator. Now, TCS is applicable only if so there are e-commerce now. Under e-commerce operators also there are two types. One is a e-commerce operator like Lenskart. Now, Lenskart is selling its own products on a e-commerce platform which is owned, managed by it. Now, in this case, there is no TCS liability. But in case of supplies through Amazon, now Amazon is not primarily selling its own products, but it is only providing a platform to various suppliers to list their products and sell it through its platform. Now, in this case, TCS will be liable. So TCS is nothing but basically 1% of your consideration, which is to be given to the seller of that product, is collected by TCS and deposited it with the government. And then that portion is reflected in the electronic cash ledger of the seller. And the seller can then claim that GST credit from his electronic cash ledger. So the e-commerce operator files GSTR 8 on a monthly basis. After that filing, the TCS which the e-commerce operator has collected will reflect in the electronic cash ledger of the supplier, and the supplier can then claim that portion. When the TCS is reflected, yeah, your e-commerce operator will will file the GSTR 8 on a monthly basis. So it will reflect in your GSTR 2A and not 2B. So TCS is the only credit which will reflect in your 2A. 2B is still not updated. So you can check it in your 2A and of course on the GST portal. Any other questions, Shabnam?
Shabnam, I think can we include the TCS? Okay.
Can we include the TCS value along with input credit?
No.
No. Your input tax credit is something which is reflecting in your electronic credit ledger. Your TCS is something which is reflecting in your electronic cash ledger. So if there is any GST payment which has to be made through your electronic cash ledger, that time your TCS credit will come into picture. It cannot go into your input tax credit pool.
Yeah, I think, folks, do you have more questions?
Yeah, there's one question that's come.
If any vendor doesn't file GSTR 1 of our paid invoice, then what steps can be taken? You have to follow up with that vendor. Unfortunately, the government has made the situation such that if your vendor does not file GSTR 1 or does not pay taxes, you have to go behind the vendor. So follow up with the vendor. And if still it does not help, then you block payments or probably you discontinue buying from such vendors. Is the only way out.
Because now I think reconciliation is compulsory, right?
Yeah.
Any more question? Yeah, I think there is one.
There is one more.
As you said that we cannot claim GST if we are booking the expenses under fixed assets under depreciation, then can we claim GST on laptop as that we are showing as fixed assets? So no. So again, there's
yeah. Okay. So if let's take a quick numerical example. The cost of my laptop is 70,000. Okay. GST on that is at the rate of say 10%, 7,000. I'm just taking simplicity. Okay. When I am booking in my fixed asset in my block of assets, I will be taking 70,000 and not 77,000. So what Isha meant that if you're claiming depreciation, you cannot take a GST on that. So I cannot be booking 77,000 in my block and at the same time claiming the credit for the 7,000 as well, because that is double deduction. Okay. So what the amount that will be booked is 70. 7 is the GST for which I will take my credit. And assuming this laptop is used for business purposes. And it's in the name of the company. So I have a GST number also there. So it cannot be that the laptop is purchased in my name and then the company tries to claim the GST credit. You will not get that.
Yeah.
Yes, it is for business purpose. Yeah. Okay. So you can definitely, yes, it's available. So I hope the response was clear.
Yes, it is, I think, because
okay, great. Okay, so Shabnam, no, any more questions? So what we've done is we've shared the PPT and the video recording is something which is being requested for Shabnam. So I'm assuming that you'll share that, right?
Yes, we will share. Plus, we have already shared. I think one of your team member has already shared your coordinates over here.
Yes, we have. Yes.
On the email also, we will share this coordinates. So whoever has any question, they can directly reach you.
Yeah, and the email ID is there on the presentation itself. It's on the last sheet. So if you want to, if you think reaching out through an email is convenient, you can do that. Okay.
In fact, what we will do now, we'll share an email with the PPT, with the PPT plus email.
I'll do that. Yeah, you can do that, Shabnam. Thanks for that.
In any mode. Okay. And yeah, thank you, Rajeshri. Thank you, Isha. It was really.
Thank you very much. You've been a wonderful audience as well.
Yeah.
And thanks to Ty.
It was a very educative and insightful session. And I'm sure, our folks understood how to claim the GST now. So, thank you. Yeah. Thanks a lot.
Thank you very much.
Thank you.
Bye.